Rahul, I think all set from your side.
I cannot lapse into Hindi. I have to, it's just an English way of doing it.
Okay.
नहीं,
Yeah.
सिर्फ इंग्लिश में बात करना है या हिंदी में भी बात करना है?
I think both will be fine.
Both will be fine. Sure, thanks.
Yeah.
Okay, fair enough.
Should be
Sounds
fine.
good.
Yeah. Thank you. Sorry, Rahul, I forgot actually. It's Pan India call, so I prefer you to speak in English only.
Done. Sounds good.
Yeah.
Yeah.
Thank you. So, Rahul, I'll be starting in 3, 2, 1. Yeah. Very good morning to one and all present here. I want to extend my heartfelt thanks to each one of you for joining us on the weekend to attend this special event with Mr. Rahul Pal, CIO Fixed Income of Mahindra Manulife Mutual Fund. Your presence and dedication to learning and growth are truly commendable. I would also like to extend a very warm welcome to Mr. Rahul Pal. We are honored to have you here today with us, and you'll be sharing some insights of the NFO of Mahindra Manulife Multi Asset Allocation Fund. Your expertise and experience in the field of finance are truly inspiring, and we are eagerly looking forward to your invaluable support and insights for the same. Thank you, Rahul, so much. And I would like to brief a small introduction about the Rahul and his past experiences. So basically, Rahul Pal is a chartered accountant. Prior to joining Mahindra Manulife Investment Management Private Limited, he was associated with Taurus Asset Management Company Limited as CIO Fixed Income. He has also worked with Sundaram Asset Management Company Limited as fund manager, fixed income. In this role, he was responsible for managing and overseeing the fixed income portfolios. So, thank you so much, Rahul, for spending time today for all of us. And it's over to you. Thanks, Rahul.
So after the call, I wish that after the call you go back and with some idea about how different that what we're talking about, and with hopefully a little more insight in what our funds offer. Uh, so what I do now is that I switch on, I move to the presentation. It's a small presentation. I can assure you that it wouldn't take more than half an hour. I may not be going through the slides, each one of them. I will flow in and out of them, but hopefully I have a context to it. The presentation is the anchor, and I'll be developing the context of our multi-asset fund in and around that. And hopefully it will not stop at the multi-asset, but we'll be speaking a bit more than that about how to look at asset allocation. Let's start with the presentation now. I hope I'm audible. I mean, I need a sign off on the acoustics. I hope I'm
Yes,
audible.
Rahul, clearly audible.
Sure. Thank you so much. So Mahindra Manulife has launched a multi-asset allocation fund. Then the fund is open now, and we close on March the 5th, if I'm not wrong. So there have been multi-asset funds by all mutual funds in the past 1 year. The category, I believe, is close to a 60,000 crores category and growing. So the question would be, I'll try to address two questions. One is, what is multi-asset? People would have heard about it, but let us give our own views about multi-asset. B is, what are we doing about it? Are we different in any fashion, or we're just the same? Those things are very important for us. And I just wanted to set a background, a preamble to the fact when we had thought about our fund. So multi-asset is just it's a self-explanatory, which means that a multi-asset allocation fund needs to have more than two assets, predominantly. And in India's context, it is equity, debt, gold and silver, and other exchange traded commodity derivatives. That's what the definition of an definition of a multi-asset should be. That is a mix of different asset classes, and that is also the desire of the regulator. A mix of different asset classes. So essentially, why do you need a mix of different asset classes in the portfolio? The usual answer is diversification. But I guess what people do forget is this, is diversification leads to lower volatility of returns. That is, if you have a risk asset that delivers X, and let me put it this way, equity as a risk asset delivers X, you need a multi-asset fund which balances asset in order, or the desire is to achieve the 90% of the X return or 85% of the X return with a much reduced volatility. That is the desire of a multi-asset fund. Nothing more, nothing less. It is neither a conservative fund, it is neither an aggressive fund. It is neither a debt fund, it is neither an equity fund, it is neither a commodity fund. I keep on re-emphasizing this. It's just that multi-asset fund. It is not meant to save tax also. A multi-asset plays on the asset cycles, and it ensures that after playing through the asset cycles, you get a return which is close to the risk return at a much lower volatility. So what are we doing different about it? I will run through the slides now, but let me put it this way. The first thing, we are a hybrid taxation. That is, after 3 years of staying put with our funds, you get a taxation which is based, you get the indexation benefit, and after that you get a 20% charge after the indexation benefit. But more often than not, after 3 years, the taxation of equity, which is 10% now, LTCG, long-term capital gains is 10%, and a taxation after indexation, applying the indexation benefit, more often than not is same. That is, at the starting point, the patient's capital that one puts in 3 years, in this case, ensures that you have an equity-like taxation. It's a hybrid taxation. Indexation benefits get applied, and yet more often than not, and sometimes even better, that you get the benefit of, if it's close to a 10% equity taxation on the LTCG or else less, but you're mostly tax agnostic after 3 years. That's the starting point. So what we're doing is that we're building in patients' capital for 3 years, and you're removing the taxation effect after 3 years, after you stay put with us. But in the 3 years, you would like to play the theme of multi-asset. That's what patients' capital does to you. The investor stays put, allows the scheme to perform accordingly to the assets allocation. And also I would like to I keep on reminding people why to look at asset allocation. Of late, I've been seeing people talking about Japan scaling, after 1990, you hit a new high in 2023. I mean, if you look at the Japan Nikkei 225, you will say it's almost a beautiful U-shaped curve. I mean, it's the from 1990 today till today. It's a perfect U in terms of the market movements. But that's what people are talking about. I mean, listen to the media about the fact that Japan just hit a new high, just climbed a 1990 high. So I ask people a question. Where was the Japan 10-year in 1990? The risk-free return. Well, normally, and today, the 10-year risk-free return in Japan is close to 0.7% to 0.8%. It's an absolute low. But cut back to 1990, Japan 10-year, the risk-free was 8% plus. At that point of time in 1990, people just forgot the concept of asset allocation. A risk-free return was beyond 8%. They believed in the primacy of one asset class over the other, equities, real estate, etc. They just forgot to look through what was the real returns offering, or what was a risk-free return offering. A multi-asset fund as an anchor as a conceptual anchor, keeps on looking at the risk-free return offered. The risk-free return sometimes becomes too good not to be ignored. Some people made a mistake in Japan in 1990.
Rahul,
Yeah.
extremely sorry to intervene in between. Your slides are not moving.
Yeah,
So, are you
no, no,
making
I'm
it
just
a
moving.
free flow?
Oh, yeah,
Sure.
yeah, it's a free. I'm moving the slides now. Thank you, thank you.
Sure,
I just
sure.
wanted to
Yeah.
start as a preamble because Japan was in context now. I just want to talk about the contextual reference. To people talk about the equities in Japan. Someone just forgot to look at 1990, the Japan 10-year, and with that uh, humbling experience of Japan, I start with a multi-asset allocation. My presentation.
Sure, sure. Please continue, Rahul.
Yeah. Sorry, I got muted. I don't know how. Yeah.
Yeah.
So
Yeah.
when Ray Dalio was asked the question about asset allocation, and he simply said what everyone knows, but it took a Ray Dalio to say that. An asset allocation, a strategic asset allocation that assumes that you don't know what the future is going to hold. That's very critical. The last two sentences. You don't know what the future is going to hold, hence an asset allocation. I'm getting muted a bit frequently. Okay. So why does asset allocation matter? Point number A different asset allocations perform differently in different cycles. That is the most important thing. They perform differently in different cycles. You reduce your dependency on a single asset class, and at the end of it all, it helps you to mitigate volatility of your portfolio returns. The third point is very important to help mitigate volatility of portfolio returns. You know about the you know about the talks on gold and silver, what does debt do and what does equity do. But if you do it well, a combination of the three, you end up reducing the dependency but also mitigate volatility of the portfolio returns. So this is self-explanatory. I wouldn't belabor much on this slide. To just emphasize the point that there have been cycles where gold has outperformed in calendar years, both bond and equity. There have been cycles where bond has been an outperformer too. It's just that we keep on forgetting about it in times of calendar years. But then fairly there is a cycle, and there's of course the overarching thing is about an overarching equity being a strong torch bearer of returns. But there have been long periods also when probably other asset classes have also helped you get a better return. So this is one of the key slides that we're talking about. One, and remember, this is just the Nifty 500 3-year rolling return. Every day from December 2008 till December 23, which is a fairly long track record, we have computed the 3-year daily rolling return. The average return is close to 12%. What is not important is the average return. It can be any average return across the globe in any equity. But the fact is, this acts like an anchor, a gravity. Either way, either you get pulled up by the gravity or you get pushed down by the gravity. But never ever forget the anchor. The anchor is at 12%, and through the cycles in the last 15 years, you have seen the returns move in and around the anchor. So, as they say, that market mean reverts. Asset returns mean revert. It's just the human mind which says that looks difficult. We challenge some facts based on our own interpretation. But when you lay down the data, it presents a very compelling picture. And this picture talks a lot about what we often ignore. Asset returns are cyclical. Returns do come back to the mean. Mean reversion, either way, is a powerful phenomenon. It is never a if, or it's never an if. It's always a when. And asset allocation tries to help that answer. You just don't know, when it is going to happen, why it is going to happen. You know it happens. You know with the humbling fact that it happens, asset allocation return moves. So this chart is a reminder of the anchor or the gravity, as I call it, and how you mean revert and move away from it, come back, move down away from it, and again come back. But you always do that, and it's not India specific. Every geography goes through this. If it's not an India speciality, it's an asset speciality. Every asset class, irrespective of the asset class, it it mean reverts on its returns always. I mean, surprisingly, debt kind of also follows a mean reversion. Remember, the green line is again the mean revert. We have used the same index, December 2008 till date, and at this moment, debt is below the 3-year rolling return. I keep on reminding people it's a when and not a if. What if? Don't fight that answer. It's just that you do not know when it will happen. That's so both asset classes follow a similar train. In fact, every asset class follows the similar thing. This is gold. It again goes up, consolidates, and goes up again. An asset allocation fund is not in love with any particular asset. It just believes in the idea or that assets have a cycle. Play accordingly to it. There is no conservatism, there's no aggression. Just play the asset cycle. So, emphasis on the fact that while you may have loved gold, it may not have been your best performing at a particular period of time. And if you have to ask someone, I go back to history again, 1980 to 2000, when if people know about the history of gold, gold was the poorest asset in terms of, as in terms of giving you the invest dollar gold. Do not confuse with the India gold. India gold has always the rupee depreciation factor to it or the rupee volatility factor to it. But the benchmark dollar gold from 1980 to 2000 did not perform at all. It was an asset not to be owned with the benefit of hindsight. The entire 2 decades from 2000 to 1980 to 2000, gold became a darling only after 2004-5, and which also coincided strongly with certain other asset classes. But the point is, gold was not the asset to go for a large part of 1980 to 2000. It was never the asset for reckoning. It came to life only now, or it's been the last decade and a half that it has come to life. But before that, it was almost a dead asset. And by the way, 1980 to 2000 was a period where there was a larger geopolitical uncertainty. Remember, it was Cold War era, Soviet Union was breaking up. Gold should have performed then. Well, gold did not. It did not offer you a safe haven as we think the gold does when geopolitical events haunts you. But maybe not. I mean, there are other factors too. I mean, talking about geopolitical uncertainty or inflation is probably not the correct way of looking gold. Gold goes beyond that. Geopolitical situations or inflation is the reason for. I mean, it's one of the deciding factors. But what we believe at the end of it all, if there is an evidence of large real returns, gold fails to perform as an asset class. Between 1980 to 2000, I mean, this is not in the charts that we have, but it's just something that I'm talking about. Between 1980 till 2000, the US real returns, that is US 1-year treasury minus the US CPI then, was an average 3% plus. And after 2005, the average US real returns had dropped below in a negative zone, or it was nothing that you could be talking home about. A large driver of gold price on a dollar context turns out to be real returns. That's what my personal thinking is. And if you do a behavioral exercise with people, and if you ask them that would you invest in a good I mean, you do, if somebody were to come to you and ask you that the government of India offers a GSEC of 7% for 3 years, and if somebody were to tell you that you that there would be marginal inflation in the next 3 years, you have two choices: buy the 3-year government of India bond risk free, or buy the gold. I mean, you'd probably say if inflation is low and I get something out of the GSEC which is available at 7%, you would probably move towards gravitate towards GSEC. That is what drives. It is real returns offered to the investor which may drive gold. At least history seems to suggest that. I mean, if you turn back the leaves of history, it seems to suggest that. Okay, this is gold versus silver. Directionally same, but in the last 3 years, dollar gold has outperformed silver by close to 5 to 6%. It is unusual. Gold does outperform silver on a 3-year basis, but such large outperformances by gold as an asset class is rare against silver. Directionally, they have the same movement, and our multi-asset fund would play the gap between gold and silver as and when required. Okay, so now I would point to this slide. It's a very simple slide. The blue line is a Nifty 500. The gray line is a composite portfolio of 50 Nifty 500, 40 on the Crystal Composite Bond Index, and 10 on gold. A static portfolio, a blended based on the blended index. Turns out that the blended index is also very competitive vis-a-vis pure risk return. A Nifty 500 assumes 100% equity. Blended portfolio assumes a 50% of the index. So if you do that calculation based on the index blending, you'll achieve a return close of 12%. If you do it a non-index blending, you will also achieve a return which is very, very close to on an average of 11% return. But the point is, you would achieve a return with a 50-40-10, at least 80 to 90% of the risk return is what you achieve. And we talk about it in the next slide. So please do take a note of this slide, and I seek your indulgence now. Specifically, the first one on your left, which talks about Nifty 500, and the extreme right, which is the composite portfolio. Take a note on the averages. I know, and the averages or medians are almost similar in this case because it's a long portfolio. It's a long tenured numbers that we're looking at. So the average Nifty is 12%. Nifty 500 is 12%. We had talked about it in our earlier slide, with a volatility of 7.55, a standard deviation of 7.55, which assumes a one standard deviation is 20%, a two standard deviation is 25% returns. And of course, with the minimum returns for a Nifty 500 over a 3-year period is minus 9.61. Fair enough. But what is more interesting is to look at the composite portfolio, an average return of very close to the Nifty 500 return. But what is more critical is at half the volatility. That is the desire of an asset allocation. Take a shot at the risk return because you're multi-asset and you're supposed to also play in, there's an interplay between the asset classes. Play it, and this is by the way static. So yet you would achieve almost 80 to 85% largely of the risk-free return, which is Nifty 500, but at half the volatility. And in a 3-year period, unsurprisingly, you never have a negative return in the even a static 50-40-10 does not give you a negative return. Hence, what we're talking about in a multi-asset fund is simply what is the ultimate desire of a multi-asset fund. Now, the ultimate desire, it is neither a debt fund, it is neither an equity fund, it doesn't try to help you save tax. It's just that can you, through your asset allocation in 3 years' time, deliver a return which is close to the risk return, but at a much lower volatility? That is the desire of any multi-asset fund. So, so I keep repeating to ourselves and to everyone else also that the desire of the multi-asset fund is to play the asset class accordingly based on their cycle. And if it's a job well done, or even if it is good job done, you will be achieving 80% of the risk return at almost half the volatility. And that is important. 80% of the risk return in a 3 year period at half the volatility. If you keep on reminding yourself, in fact, we keep on reminding ourselves of the what is the ultimate job of our multi-asset fund. At the end of 3 years, after in fact having a neutral taxation between equity, it will seek to achieve 80 to 85% of the risk return at a much lower volatility. That is our goal in our multi-asset fund. It reduces volatility, achieving those returns or almost those returns. So this is the historic number of the composite. This is a static portfolio, 50, 40, 10. Above 8%, it has been 81%. Above 6%, has been 92%. And yet the composite has never delivered a negative return. So we just wanted to sum up on the static portfolio side, 50, 40, 10. What do the numbers tell? Well, unsurprisingly, you have had lower losses during the bear times, and you had healthy returns during the bull times at a lesser volatility. You will do either way, but you will be doing everything at a lesser volatility. Okay, now I just finished talking about asset allocation and why an asset allocation, the tax part of it. I'm specifically also going to our schemes and how we are doing it a bit differently, we feel. I mean, the first fact is we are unconstrained in our asset selection. That is, equity, we are talking about 35 to 80% as and when the situation is required. But the minimum 35 is because of our taxation needs of equity and equity related portfolios need to be 35% in order to get the benefit of indexation. Debt and money market securities, 10 to 55%. Gold, silver, and other commodities, 10 to 30%. And REITs, 0 to 10. I'll just touch base upon equity. We have a slide on equity, but I'll just help you gather the thoughts as we're talking about it. The minimum is 35 to 80. The equity allocation will be a flexi-cap approach, unconstrained on the market capitalization bias. Our fund manager is Ranjit, who looks after the equity portion of equity savings. He also is co-fund manager who also co-manages the business cycle. So we would like to, our thoughts are broadly about largely replicating the equity portion of the equity savings. Largely, I mean, and then after that it is a call, but it's a flexi-cap approach. Equity savings is also a flexi-cap approach. And that is what the equity, and that's on the equity side. Debt is 10 to 55%, dynamically managed, based duration calls as and when required, credit calls as and when required. Gold and silver, it's 10 to 30, and other hard commodities. At this moment, we are not, we are not pro commodities, hard commodities, simply because we believe that, equities which surrogates of equity surrogates which have an underlying commodity base do much better than commodity per se. That is, if you are bullish on a gold, aluminum, if you're bullish on aluminum, copper, steel, more often than not, history has shown that companies are better than commodities. Remember, companies get the get the operating leverage, which theoretically translates into multiples which get better off. So play the companies more often than not. You get much better returns for the investors rather than playing hard commodities. As a multi-asset fund, we would like to believe that companies offer a better play than the underlying commodities. When do we start looking at commodities per se? Let's say suppose there's a global phenomenon of harsh windfall taxes. You may start have to re-looking at the whole differentiation between commodities and commodities and stocks. Or for that matter, there are commodities which do not get adequate representation in stocks. Start looking at it. So, but at the heart of the principle of commodities is that the stock play on the commodity is better than the pure hard commodity per se. So, so that's our theory. So we start with gold and silver, which is tactical. REITs, we will have marginal allocation to REITs, but the REITs is a tricky asset class, is what we believe in. There are certain, in our framework of taking units of REITs, there are certain no-goes. We have them. So that leaves us with a small bunch of REITs. I mean, in fact, there is a small bunch of REITs by itself. But we do carefully look at that asset class. We don't want to jump to the conclusion that REITs are an asset to have it. Because remember, as I said in the starting, you always compare against risk-free. Never, ever leave the risk-free out in the context. So I talked about equity. I talked about debt. The debt fund management as a strategy, taking accruals. Well, accruals look good now, as you know, the fact that spreads have expanded in credits. Good quality credits are getting a look in because spreads have expanded. We'll probably start with healthy quality credits in our portfolios because we have a minimum 10 to 15% allocation, and we build gilts, duration calls through gilts. The division of assets between equity and debt is devised internally, and at this moment we have our internal rules suggest that we should be close to an equity allocation between 50 to 60% as we start. Yeah. So why Mahindra asset is what we have been talking about. Indexation benefits. So yeah, I'm almost done actually. But as I said, the enemy of a good asset allocation is the quest for a perfect one. Fight the urge to be perfect. As to say that you should not make good the enemy of best. If you do a good job, it's almost close to perfect. So our idea is to do a good job about asset allocation. Our rules on asset allocation ensures that you do a good job about it. So internal investment framework, most of you have been well aware of that we follow an equity framework of GCMV, which is growth, management, cash flow, and valuation. And if you have a valuation gap and you have catalysts aiding to that, there are multiple expansions to it. That's what the way of looking into our equity framework. And I can assure you, we've done an incredible job in all our funds on the equity side. So the underlying concept is there. This is an asset allocation fund. The underlying remains the same, unconstrained equity, and the allocation is decided by rules, the selection by the fund manager. And he also is this is what his largely his framework is, and you can be rest assured that it has been an incredible performance. So this is the mandate. 35 to 80% quantitative models. There's some rules around fixed income yields and valuations. We have to ensure 35% and maximum 80% as mandates as applicable. This is our debt philosophy. Largely look at credits, look at duration risks, and have a blended portfolio. And I also want to talk about the fact. I mean, certain facts which are left unsaid in the industry is that if you have a multi-asset fund with an equity taxation, it leaves very, very little for debt as an asset class to play, because it will largely be driven by arbitrage and arbitrage-like returns. And so it's basically a multi-asset fund. We believe, at least I personally believe, a multi-asset fund with an equity taxation is almost a balanced advantage fund with gold attached to it. You do not have a large play of every other asset class, every other asset. So what if we believe in the case for multi-asset and asset allocation, we believe a hybrid taxation and the patience capital of hybrid taxation allows you to do that. That's what our desire. Otherwise, you would have said the fact that Why don't you take our balance advantage fund, build in 15% gold, you get the multi-asset fund with a no with an equity taxation or a 15%. You can talk about an SGB or sovereign gold, but and you're through. But that's not what always the desire of a multi-asset fund is. A multi-asset fund is just that. Play the asset allocation cycle as and when required. You're given 3 years time for it, reduce volatility, achieve a risk-like return largely. So, and we just have a small illustration on how the effective taxation now is had you redeemed after 3 years and assume a similar return of 9%. No, a composite portfolio, if it assumes a 9% return, remember it is almost tax agnostic that after 10%, if equity long-term taxation is 10%, indexation with an indexation benefit, you at this moment you're slightly better off, but as a taxation, but more often than not, you are almost equal. So after 3 years, you can be rest assured that you are getting an equity-like taxation. You play the asset allocation with the desire that at a lower volatility, you achieve almost the risk return. That is why our multi-asset fund. And in order to achieve that, we have unconstrained approach. 35 to equity, 35 to 80 on debt, 10 to 55 on 35 to 80 on equity, 10 to 55 on debt, 10 to 30 on gold. We have given ourselves large bandwidths so that you play the asset allocation, you're getting time for it, and after 3 years, investors are equal in taxation. And you do it all of it achieving a lower volatility. Yes, that's it from my side. Any questions? I'm good to go. And thank you all for listening in. And if any questions, I'm good.
Yeah, so thank you so much, Rahul. On behalf of our team, I would like to express our sincere gratitude for your insightful presentation on this NFO. Your expertise and deep understanding, of course, is really dynamic and truly enlightening for all of us. And we are excited about the NFO. And I just want to assure you that you have our wholehearted support. And we are confident that with your leadership and clear vision, I think the fund will achieve the great success. So let's move to the questions coming from IFA's end. Yeah. Yeah. So my first question to you is, don't you consider if investor holds it for short term, then there is a disadvantage in the taxation front?
Oh yes,
you
absolutely.
just explained the taxation scenario,
absolutely,
but
absolutely, absolutely,
yeah.
Absolutely. The answer is it a disadvantage in taxation front? Well, let me put it this way. If your short-term returns are dramatically positive, it's a disadvantage. If not, maybe not. A function of the returns. So you understand what I'm talking about. That is, for some reason, if you have your multi-asset fund, which does better off even than it discounts that 10% and the 15% or 10% and 35% differentiation through its performance of asset allocation, maybe not. But the first answer is yes. And then you say that should your asset allocation after tax return, because it does a job of asset allocation, perform well even after paying tax? Maybe not. No, we would jump to say yes. In a short term, it is disadvantageous percent because it's a gap of 35 to 10. But remember, it's a gap. It's a hypothetical gap. You are not considering returns. Should the returns make up for the gap? Maybe not.
True. I have a similar question to this, only actually continuation of this question. As you explained me the debt taxation scenario, one of my IFA is having a question that if equity allocation question that if equity allocation is higher on side, what if it is 80%? Then the taxation of equity, what will be the consideration for taxation? It will be equity only, right? Then there'll be no indexation benefit.
It's a hypothetical answer is yes. That in a
Right.
12, the hypothetical answer is yes. But remember, a 35 to 80 is based on the principles of multi-asset. No, unconstrained asset allocation when it does, but when it requires. But yes, hypothetically speaking, if it is 80% for more than 8 times in a year, it actually becomes an equity taxation. Is what is 65% plus is what the income taxes, taxation taxation's rules are. But largely, we believe the fact that when you consider product to perpetuity, it will be following the extent hybrid taxation.
Correct. Thank you so much. We'll move to next question. So it's what kind of investor choose to invest in multi-asset fund and what will be our target audience? So I think this question will help all our partners to choose their target audience wisely.
You know, an investor who seeks an asset return, who is comfortable with the idea that you're probably getting 80% of the equity return, but at much lower volatility. Target an audience who strives a lower volatility and yet tries to, and he's not saying the fact that, okay, I want lower volatility, but I want an asset return which is equal to the best asset at that point of time. And we are assuming equity, but let's assume it's equity at that point of time. But you cannot say that I will get the equity return in a multi-asset at a lower volatility. You will get I keep on repeating, the best possible return during that 3 years phase at a much lower volatility. It's because remember what we said about trade value. You do not know the future and hence you're building up the multi-asset fund or an asset allocation mix. When you do that, you simply, if you want an easy conversation, the answer is like this. That whatever assuming equity is the best performing in every 3-year cycle, the multi-asset fund will try to achieve 80% of it at a lower volatility. Volatility is the anchor with large participation in the upside.
True, correct. Thank you. Yeah. So the next question is how many multi-asset allocation fund one should have in the portfolio, as there are many competitive companies have come up with the same. As you must be aware, Bandhan have come up with the same theme, then BOI, HSBC. So what one should have in the portfolio, basically?
Okay. I wouldn't want to name competitors, but people who have come up with multi-asset with equity taxation, I repeat, is largely a balanced advantage fund with equity, with gold, largely speaking. Now, I would like to believe that it is not a multi-asset. That's simply, you cannot define that as a multi-asset because remember one thing, if you have tax in your mind, you can as well play balance advantage fund. No, if you have to tax, if you want actually your idea is saving the tax, I get it. But you have equity, you have aggressive hybrid, and if you want a conservative portfolio, you have equity savings. The mutual fund offers you everything which is equity-like taxation. Everything. You have an equity savings which has a lower equity allocation, lower volatility. Your balanced advantage fund, which tries to do between equity and arbitrage, likely leaving debt portion which is small, and an aggressive hybrid fund plays a 75% equity. You can play either of them, but you can't play the multi-asset through it. The idea is multi-asset. The idea is not to save tax. The idea is not to be conservative. The idea is not to be aggressive. In order to achieve all of this, you have an existing bouquet, and every other mutual fund has this bouquet. It's not us, it's every other has it. But a multi-asset has a different role to play. Like we keep on emphasizing, and we've been hard pressed for this answer because we're one of those few guys who are offering a multi-asset. And in a multi-asset, when you decide you have patience capital, you cannot constrain yourself. कि मैं इतना ही रखूंगा इक्विटी में, मैं इतना ही रखूंगा डेट में, again that multi-asset then will fall in a flat foot if you say that I have put constraints. So what we have said is that if you want to have equity like taxation, please, we have balance advantage as well as multi-asset. If you want conservative approach, please play our equity savings. That is a conservative approach in terms of limiting your equity. You have all the three, and you get an equity like taxation. But if you want to play the theme of multi-asset with the desire that I have to lower volatility, the time is required for that. That is 3 years. And constraints should not be there. That is, I keep a constraint on asset classes. That should also not be there. So, and that is what our theme is. And that is what we are trying to be different. And we know it's a difficult job convincing people that that hold on for 3 years and get a lower volatility at almost an equity like return. So that's a difficult job. But then we know we're trying it, because had we not tried this approach, we would have never launched the fund in the first place, because everything else is there in our. We also have in our fund book at exactly all of that. And yet we have launched the multi-asset with an idea that since our existing bouquet does not help the concept of multi-asset, so it is needed in our product basket. And maybe someday, this may be one of the largest categories you ever had.
True, true. Thank you for throwing the light on the same.
Thanks.
Let's move to the next question. So, yeah. Is it better for conservative investors to invest in either balance advantage fund or multi-asset allocation category?
Okay. So my question is, how do you define a conservative investor? That's the idea. So our idea is that you have to define his ability of risk, which is volatile, which is which I said is volatility of returns. If you want to reduce volatility, multi-asset. Multi-asset